let's start off somewhat different and then answer your question more directly. Let's just agree that valuations, by and large, are um, a reflection of supply, of some sort of supply and demand, right? And some sort of market sentiment confidence, if you like. So when we're all very bullish, thinking the market can only go one way, valuations creep up, and in some ways, they start to get into some ridiculous numbers, right? And I'm not going to give stories or tell about specific companies, but we've all seen deals and we've all seen certain valuations where you're like, how did they ever reach that number? Okay. And equally, when times are difficult or companies are doing well, entrepreneurs, even in good times, are forced to sell more of the company to an investor than maybe they would have liked to in a different situation. So what's happening right now is no different than what would happen in other circumstances, except it's definitely every investor is looking at all deals and thinking, is this a good value to me? All right? Is this a good investment value? And frankly, yes, some investors are, pushing down valuation or putting in terms to protect themselves, in terms of what happens next. Is that a negative mark on a company? No, it's not, right? Not necessarily, but I always warn entrepreneurs who come and seek advice, even if we're not investing, I would be more careful with the terms that you agree than necessarily the number. Because the number 5 million above, 5 million below isn't going to be the issue. What's going to be the issue are things like, did you have a full ratchet rather than a weighted average ratchet in terms of anti-dilution? Did you give away certain rights to that investor that maybe other investors will find very difficult, like they get to choose whether to sell the company or not? Some of those rights can make it impossible to, when things get better or when the market improves, to be able to raise additional capital because that investor has got something too onerous.
Okay, so I mean, the things that founders had to look out for before still hold true. It's just perhaps the degree to which they need to be a bit cautious has increased a little bit. Noor, what are your thoughts on that? I mean, are founders a little bit more cautious? Sorry?
I would agree. I would also add, as a general principle in life, and particularly here right now, is, always put yourself in the other person's shoes. So as founders approach investors, one, the situation now means that investors have a lot more opportunities because it's harder for founders to raise money. So as a founder, you have to position yourself a little bit more, more differently. The other thing is, keep in mind that we as a VC fund, for example, will be held to higher standards and more accountable to investments we make at this present time. So when we go out for, whenever we want to raise our next fund, if we do that, the first thing investors will say, well, what did you do during the crisis? What did you invest in? Why did you do that one? What were the terms? Why couldn't you get better terms given that it was a crisis? So when founders put themselves in investors' shoes, they tend to understand better why investors do and say certain things and how they can accommodate those concerns while not giving up too much of their own rights, as Bassett mentioned. So it's a very much a balancing act. And I think, founders at this point need to just be aware that investors will get held doubly responsible for decisions they make at this point in time. So the value proposition that the founder brings to the table needs to be much higher, whether it's on the idea, the market, the sustainability, or the terms.
So, I mean, founders should also treat like investors as people who are also accountable to, their investors, and they have to answer those questions as well.
I always think it's funny how founders often forget that VCs have to raise money too. Yeah. So it's kind of like we are in your shoes, we get it, and and we have to go out and do the same thing, and we are held just as accountable as you are for our performance.
Yeah, definitely. And I mean, that just brings up an interesting question. I mean, you briefly mentioned it earlier. how has the VC, let's say, aspect of raising money been affected? Like, is it easier to raise capital? I mean, I'm sure it's not easier, but what's that looking like from what you both have seen so far?
You know, we're very fortunate that we closed our last fund, you know, late last year, and that we're in a position where, you know, we're now actively investing, and I think that is great for us. Our fund's vintage is 2018, and the irony of it all is that there's more correlation between a fund's vintage year and their performance than anything else. So we're hoping that 2018 is a good vintage, but I don't have a straight answer for that question.
No. Okay. Well, Basil, from your perspective, you know, just a general question. Do you think VC investment activity will continue? I mean, these days we're seeing so many articles come out that this startup raised a round and that startup raised a round. Is that a signal of increasing investment, or is that just rounds are closing? And what's the outlook for the future?
You know, Philip Bahush at Magnet and I always take a bet at the beginning of every year about, will this year be more money raised or less money raised, and which country? Actually, I think we even wrote an article about it this year. And if I knew what was about to happen in March and April, I would have told you it'd be impossible to predict. I'm still of the view that this year will turn out to be a very strong year for fundraising, with very different circumstances, right? I think early stage, in my opinion, angel investing will see a bit of a hiatus, but will continue. You know, there are still individuals who are very much looking to deploy capital in early stage ideas and sort of figure that out. And I think later stage companies, bigger rounds, I still will think those will be pulled together because many of these companies are in very strong positions now in the market. Their e-commerce platforms have accelerated. Whatever solution they provide have accelerated. Not everybody, but a lot of them. Let's put it that way. So those two extremes of that bell curve. The middle part is going to be the hard part, frankly. This ecosystem is, you know, we have VCs. The VCs will continue to invest, but was heavily supported with family offices and, let's say, super angels or people who, you know, or individuals who could put $1 and $2 and $3 million checks at a time. That part, I think, will see a little bit of a pullback. You know, a family office doesn't only invest in technology, they also have real estate, they also have their own businesses and so on. And I think they'll take a little bit of a break. So the middle section, or companies that are kind of doing a series A, B, I think we'll find it a little bit more challenging this year, Hisham, in my opinion. But RBC is going to continue. Yeah, there is dry powder and money. The deals that you're seeing, all of them, I think, are fantastic. A lot of them had started before the pandemic, so it makes sense that now they start to close because people waited. As the market comes back now, people can be more confident about deploying the money. And net, I think the year will be good. I actually, with everything going on, I think it will be good. But let's see. It's a long year already.
Yeah, definitely. I mean, love the optimism about the rest of the year and when it comes to you know, closing capital. But speaking of that, you know, dry powder and that, you know, VCs have funds available. So Noor, from your perspective, what's the logic that an investor would potentially use? Because we get questions, you know, from our companies that we work with that, oh, VCs would probably double down on their portfolio rather than, you know, start new investments or make new investments at the moment. So is that true, or do you see a mix of both happening?
It's a mix of both. So I think first what you do is triage. You see who needs the support, who needs help, and you know, we conducted kind of an assessment of where is everybody and what do they need, right? So that's the first part. And then beyond that, we're always looking at opportunities. So the question becomes, going forward, what's the upside for each of these opportunities? So for every dollar you put into an existing company is a dollar you're not putting into a new opportunity. So beyond the support that they need and the follow-on that they need to get over this bump in the road, because we view ourselves as partners. And so we're not just capital, we're strategic, we're long-term, we're supporters, and we're partners for the long term. And it's more important to be there in the bad times than the good times. So I think all VCs think about it that way, and that tends to be the answer. And that said, everyone has enough dry powder to look at new companies too.
Okay. And so I want to bring in, an aspect which, perhaps is a little bit on the basic side of things, but again, it's coming back to the type of questions that we, face from the companies that we work with. Early stage founders are almost always so concerned about the valuations of their business. So from a basics perspective, right? What advice would both of you give to them when they're, let's say, that pre-seed level, they have an MVP, they probably just launched? Should they be concerned about valuations? Do they matter to investors at that stage? So Noor, we can start from you, and then Basil, I'd love to get your input as well.
So the valuations do matter. I think that, regionally valuations have always been a very testy subject because, we feel that the valuations in the region on a multiple level, founders will argue, well, they're much lower than they are internationally. And then you could argue, well, the exits are much lower than they are internationally. You can go back and forth in this valuation argument. And the only important thing to agree on is that you will always disagree. And so if you start with, we're going to agree to disagree what a fair valuation is, but let's get to a number that makes everybody comfortable. And let's agree on a vision and a path forward and a strategy and where we can add real value. And then hopefully the disagreement right now becomes nominal and a rounding error in the grand scheme of success, and it doesn't really matter. So that's how we have kind of a view on valuations. I mean, in the rule of thumb, because I was looking at the questions here, so the rule of thumb becomes, it's 20% each round. So it depends how much you want to raise, when you want to raise it, and so on. So it's 20 to 25% dilution each round is where we see valuations.
Okay. Basil, your thoughts on valuations, especially for the earlier stage companies?
I sort of started going there in an earlier question. Valuation can be important, but I also believe the terms are more important, right? And I spend a lot of time looking at Series A companies going, I wish they hadn't done that, right? In a seed round. And Noor, I see Noor smiling a little bit because I can tell you we're going to write a book about it soon enough. About the number of times cap tables or terms that people agree to, thinking that makes sense, but only for it to really, bite them later down the line in raising more money. And let's just be clear, the VC model is built on partnership, not built on ownership between the investor and the company. And there are different partners for different stages. And you need to work, in my opinion, as an entrepreneur with people who understand that model. Because if the model is about I own you or I control you, then I think it may seem okay at some stage, but later on it causes real problems to bring other partners on board, if that makes sense, or to change the partners. So in the early stage, you want someone who can help you with formulating the idea, maybe testing the product, making some early customer introductions, helping you recruit some key talent like in sales or technology or whatever it is. Later on, it's about the governance, it's about the strategy, it's about market expansion into new markets. So you need a VC, maybe rather than an angel investor who can make those types of introductions, connections around the world or in other places, if that makes sense. It depends on the business. I'm generalizing, obviously, in this discussion. Each business is a little bit unique. And yes, it's good to have let's say you're in the car business, and it's good to have a car rental company or a family office that works in car rentals or something like that invest, because it validates your idea. But if what they invest also means they control the board and they control the voting and they control the shares of the company through some given rights, how does a new investor come in? Right? Now you get the tension, now you get the problems. And, you know, I've spent more than enough of my fair time lately unwinding problems for entrepreneurs with investors. And frankly, there are many cases where great companies, you simply cannot go forward because the terms don't make sense.
So, I mean, you know, just from maybe like the top three, because I think this is a really important aspect that you've touched on. Let's, you know, if you could, maybe the top 3 or 4 bad terms or things that like a founder should be very mindful of before signing that agreement. If you could, you know, talk about those a little bit. I mean, you don't have to give a specific example, but yeah.
I wouldn't read my book. Buy the book that Noor writes about this. You're more than welcome. You'll find lots of stories in it, and yet to be published. Now, the cap table, the percentage ownership. You see some really, you know, odd things happening where some investors given, I don't know, 15% of a company right up front. 15% may seem like nothing, but if the other 2 investors each own, let's say 40%, that 15% is now the blocking vote. Because 40 plus 15 is 55. So if the 15 votes with A, it goes this way. So it actually looks like a small percentage, but in reality, that 15% is now has a controlling minority, what's called a controlling minority vote, right? So I'm just giving silly examples this year, and one people need to think about. The board is another thing. Board seats that are given as though they are either a coffee, you know, a candy. I've seen boards get up to 7 even before they get to Series A. And now all of a sudden you're like, what are we going to do? Add 2 more board members? How many people are going to be on the boards? And is it just people are there because they want to be associated? But you can't really take board decisions. The board cannot be involved in a meaningful way because there's just so many opinions around the table, right? And everybody's voice is diluted. As opposed to, let's have a small board, maybe observers or an advisory board, but a small board that when there's a critical situation, you know, it's 3 people or 5 people who need to get on a call and make decisions, right? And take action. Those would be 2 just off the top of my mind. And then there's sort of funny things like warrants and signed letters, things that get disclosed in the middle of a transaction. We could even be halfway through a transaction and then find out about some side letter that somebody signed for fun, giving some shareholders some additional shares that weren't declared. Anyway, we find all sorts of silly things like that all the time. Keep it simple, keep it clean, work with a good lawyer that, you know, that can keep things straightforward. If you need to make tough decisions, make sure or you have to give something away because an investor is really keen on it, make sure you're getting something in return that, you know, allows you that flexibility that you need.
So the cap table is something which is super important, and you know we've seen as well. To that point, Noor, you know, when at the early stage, a lot of founders do friends and family rounds, and they end up giving, you know, 2% to Uncle Tom and, you know, 3% to this person and that person. So, I mean, is that a negative? Do you see that as a negative when there's, let's say, too many people with too less equity on the cap table? Is there a way when founders are doing a friends and family round that they can avoid this kind of situation?
So yes and yes, it's definitely a negative and it's definitely avoidable. And the way you avoid it is you structure an SPV where everybody gives the rights for the votes to that SPV, and you put all of these people under one SPV. And then when an institutional investor wants to come in, it's not a messy cap table. You don't need 17 different signatures to be able to raise money. What we want to see as investors is that the founder is in control and it's not burdensome or cumbersome to raise more money. And so the way to do that properly is to have an SPV structure. And a lot of times when we see those internationally, not so much in the region, because I think we're still trying to catch up, the SPV structure is actually called friends and family, right? So it's everyone who invests, and that way the people who you're asking to come into an SPV, not directly into the company, will understand that this is the friends and family round. We've called the SPV friends and family. Everybody belongs here and we're done. And that's it. It does. I mean, and the thing is that it does cost money. Yeah. It's gonna cost 2 or 3 months of your time and $5,000, and then another maybe $1,000 or $2,000 annually on an ongoing basis, right? But if the founder is that committed and they believe that their vision is the vision and people are happy to invest, it's also worth taking that cost on board the company or on board the investment round and increasing the investment round by $10,000 to make that happen.
So it's certainly something, I mean, that early stage founders should look at. And I think it's just about, they don't know how to go about these things because, like you said, especially from the SPV perspective, I don't think it's that common in the region yet. So to that aspect, how can founders educate themselves a little bit more when it comes to all of these things? Because I know personally that fundraising is a subject where I get a ton of questions from, the startups that I work with. So what advice would both of you give them, because as a founder, they have to know, especially the fundraising side of things. Every other thing like marketing, operations, strategy, they can probably, bring someone on board the team. So Noor, what would your suggestion or advice be when it comes to educating themselves about fundraising and the whole, aura of fundraising?
I mean, I would advise them to speak to other founders. So that would be the key thing, is that speak to other founders. What have they done? How have they experienced it? And founders who have done the journey before. So if you're trying to raise your seed round and trying to figure out how do I structure this and is it worth the expense and the documentation to get it done in this way or that way or not, talk to someone who's on their Series B, right? And like, what did you do? Did you have to fix that later? Because otherwise it will stall your A, it will stall your B. You're gonna have to go back to all of, Uncle Tom and Abdullah and the next guy and get them to sign off on, I don't mind going into the SPV, and then on what. So you end up creating so many more problems for yourself as a founder down the line, as well as hindering your future investment ability because of not doing it right the first time. And so speak to founders who've done it before and speak to friendly investors. There's lots of investors in the region, more institutionalized investors that do this repeatedly.
Okay. And Basil, your advice on, how to demystify fundraising a little bit.
I think, Noor's covered it to a large degree here, but to me, what I would say is this, right? In the early stages, a lot of it's about the individual, right? It's about that individual's story. You just demystify it by being transparent and open, not just about, it's not a sales job. If you're sitting there feel like you're selling yourself or selling the company, then I think you've missed the mark. But I think that you need to talk about your strengths and weaknesses, why you want to do this, what's the opportunity, and through the words and more importantly, the actions show the commitment that you have for that idea. That's what it is in the early stages. As you progress, it progresses more away from just you as an individual, but the team, and more importantly, the product and the clients that you work with. And I think you'll find that if you're always, like Noor said, seeking advice, working with people around, I'd love your feedback, I'd love to be, building something meaningful, people will get excited and then want to invest. If only thing you come up and show up and says, I need your money, and that's all you're good for to me, well, you know what? Somebody else will give you that money. I don't want to give you that money, right? I'll give you, I want to be a partner. I know it sounds weird, but we're living vicariously through our entrepreneurs in the things that they build, right? And we're excited for them and with them. And we talk about the companies we invest in as though they are our own when we're VCs, right? Bring us with you on that journey as opposed to treating us like a bank, because I hate banks. I hate the way I get treated at banks, and I hate the way banks treat me. So don't treat us like a bank. We're not, that's not what we are. We're responsible for capital. We have duties to our investors on how we invest the capital, but we're excited to help entrepreneurs build their ideas.
Definitely, and I think that is something that we discuss with the entrepreneurs that we work with is because they always ask us that how do we approach VCs? For some reason it just seems like investors are very difficult people to approach, and like the advice I always give them is no, they're just people. You just need to develop a relationship with them. The first in-mail that you send on LinkedIn can't be, oh, I'm looking to raise X dollars and, would you be interested in investing? So are there some other tips that both of you would give to founders on how to approach VCs? So Noor, I think you certainly, you touched on one, which is something we recommend, which is speaking to existing founders, right? So I think that's always a good way in. But let's say they can't find a portfolio company. How would you like to be approached by a founder looking to raise capital?
So I think, the best approaches we've seen are those from our founders. So when our founders in our portfolio approach us and say, hey, I have a friend who has a company, they've typically done some of the homework for us on this person is, pretty hardcore and committed to building this company, and they have a vision and their ethos is aligned with ours. So those are some of the things that matter to us, and that's probably the best approach. It's fine to get random messages on LinkedIn, but if that comes through someone who's a shared contact, then it helps validate and vet. Because at the end of the day, this is a people business, and we invest in people and relationships, and those, as you said, take time to build. And by going through a trusted person, you reduce the amount of time.
And you live in a world today where a lot of that's already visible. It's not like we're hiding what our portfolio is, or we're hiding who our contacts are. Go on LinkedIn, you know who we talk to. I mean, it's really not that hard. I find it surprising. My favorite one is where somebody's connected to me on LinkedIn, I've already accepted the connection, so they clearly have access to my contact details, and they're like, and then I say to them, please email me. And like, can you please, that's my favorite one right now, right? It's kind of like, you can't even be bothered to get the email address off of my contact on LinkedIn, right? Or the one which is like, they come up with an idea that's exactly like another one in our portfolio, and they don't know that we have that company in our portfolio. So, they're coming to talk to us like we've never made an investment in that space. It just shows a lack of curiosity, which in itself is already a red flag. So if you want to approach a VC, get to know us before you approach us. Not for anything. Your message will be better heard when you put it into the context of the companies we've invested in, the people we know, and ideally have someone who's willing to vouch for you as why we should spend time. I don't mean to be arrogant, and it's not in any measure of arrogance. We receive a lot of requests. Our job is to filter, right? Meetings and how to spend time. If someone references, a founder, like Noor said, references you, then you'll immediately go to the top of the pile, right? But if you're not referenced and you haven't done any research, and you come along and you say, I have, I don't know, let's say, take your favorite one. I have a mom, we've invested in Mom's World, for example. I have a mom and baby e-commerce site. It's going to be the best site on earth. Can I please send you my business plan? What is, you know what I mean? What does that do for me? If you say, I know you've invested in Mom's World, but my idea is different because of this. And by the way, I've been speaking to one of your founders about it, and he also thought it was a good idea for me to reach you. Now you're up here. I don't want to give away all the the secrets, but that's definitely one of them.
Yeah, I mean, suddenly you don't want your LinkedIn to be flooded with all the secret tips that you're giving in for founders looking for investment. I mean, unless you want that.
You say it, we say this advice over and over again, and we still receive messages with people who haven't even bothered. I think if you're lazy about doing your work, then don't bother being an entrepreneur, frankly. I mean, it's that simple. This is the most basic work you can be doing, which is talking to people in the ecosystem and getting their advice and finding out, how investors think before you start fundraising.
Absolutely. I just wanted to ask one question before we get into the Q&A, because we have a couple of questions that I'd like to run through as well. And it's less to do with venture capital, but just, in terms of, founders that are facing cash flow issues at the moment. So apart from venture capital, what are some of the different options that a founder could utilize right now to get some working capital into the business to solve some of their cash flow issues? Could it be that they go for a loan or a bridge round? What are some of the suggestions that you would be giving apart from approaching VCs?
So I think, there's two answers to that question. One is obviously, it's very hard to get financing and loans in this part of the world. And we've talked through the whole angel and friends and family rounds. I think over the last 5 to 10 years, there's been this trend towards raising capital is the most important thing a founder can do. And I think that there's a little bit of a mistake in there, because if you take a look at entrepreneurship for decades and decades before that, or hundreds of years or thousands, it was really getting your first client. That's the most important thing you can do. Generating revenue. And then with that revenue, you build your company, you get more revenue, you build more company, and you grow, right? The whole concept of raising capital without having revenue or off a business plan is not something that the region has embraced wholeheartedly, because it's not the way that business has been done for ages, right? So as you go, you build a company and then you raise the money. Now you go, you raise the money and you build the company. So my advice to founders that are really committed and really believe in what they're doing is try to build something that can generate revenues and find a client that will pay you for your service or your product or your tech, because that will prove then that this is a real operating business and you will be able to raise money so much more easily. But raising money in order to get your first client, that's a friends and family job, because people want to support you and they believe in you and your vision. It's not an investor job. Anything you want to add, Basit? I don't mean to sound harsh. Just the way that businesses are built is through clients and customers.
And I do think there's another skill that's sort of becoming more critically important. And it's a sensitive one to talk about because it has many perceptions. But the skill of an entrepreneur to be resourceful during difficult times on sourcing, let's say, I don't want to say cheap, but cheaper, right? Resources to help build their business is a big piece of it, honestly, Ishan. And I think I'll say it this way: you can go build a business with a lot of expensive people around you. I think the clever entrepreneur is the one who knows how to optimize that. I'm going to do the marketing. I'm going to use somebody on Upwork, and I'm going to pay them $100 per job rather than hire a marketing executive for 10,000 dirhams a month or something. You see what I mean? Because the difference is I'm getting value for what I pay. Yeah, it's a bit expensive on each unit, but I'm only using it when I need to, and I can stop at any moment and not spend money on this. I think that skill, especially during this time, is underappreciated prior to COVID and is being hugely appreciated, as we go through the pandemic. I've seen some of our founders be incredibly resourceful in terms of how they get, lots of things done to run their businesses. And that's a skill probably worth honing as well as is, what Noor mentioned.
Absolutely. I think, and this is something we communicate to founders as well, that money isn't the solution to your problems. I mean, certainly it helps, but they need to try to control the variables, that are in their control, reduce costs, try to make that dollar last as long as possible without, hiring 10 people in your first month of operations. So it's good to kind of get your insights as well. We've had a really, really interesting conversation so far. So I'd just like to recap it a little bit before I get to a couple of the questions. For the audience, sustainability matters now more than ever, probably. It was always there, but now it's probably one of the first things that investors are going to look at going forward. The market size matters even more now because, you know, as Noor mentioned, investors are taking on more risk. So, you know, to compensate for that, obviously they would like to get more returns, which means a bigger market. So in a nutshell, your jobs have become a lot more difficult because it's about getting bigger market shares, but in a more sustainable manner. You know, in terms of industries, some industries are have become more accelerated than other ones, and it's not about finding the newest solution. It's probably about trying to do things a little bit differently. And in terms of a founder and approaching, you know, investors, it's all about the transparency. It's a relationship based game. It's a people's game. So try to get intros from portfolio companies when you are trying to approach investors. In terms of the questions, there's an interesting one, and I kind of leave it open for either of you to answer. You know, when it comes to investors leading around, right? So should founders you typically go to a big investor that would then bring in the VCs, or should, you know, founders go for a VC that's able to lead around? How would you approach this question?
So what was the first option, Hashem, just so I understand the question?
So,
You said
the
one with
first,
a leading around, that I understand. What was the other one?
yeah. So the first option is just going to like a big investor. So it could be like a super angel perhaps that pulls in the VCs, or, you know, the other way around. How would you see that happening?
Everybody has their value and everybody comes at it with different things. You know, I guess, I don't know what our reputation 100% is, but I believe it goes along the lines of, you know, when we do an investment, we do a lot of due diligence. We spend a lot of time getting to know the company, the market, et cetera, et cetera. The value that creates for a company is that once we do commit, there are a lot of other investors willing to commit on the back of our work, just knowing that we've done it. So a VC in some ways validates, and we're not just talking locally, but internationally, right? We have VCs around the world that are willing to co-invest or do a lighter due diligence than they normally would because we've invested. And I think that applies differently for different VCs and applies differently for different angels. There are certain individuals today in the ecosystem, if they were to write a $50,000 check, a lot of other people will write checks because they're super angels and they're well known. You know, maybe the founders of some of the companies that have exited and so on, they become incredible validation for ideas. So I guess to answer your question is, I think the two options are the same, but they may have different context on when you want to use it, and when you want to make that happen. Earlier stage angels, later stage VCs.
Okay, so it depends on the stage that you're at, but both options have their own merits to answer that question. Here's an interesting one. I mean, you know, we all agree that, you know, we should reduce costs going forward, but will growth at any cost go back to being the driving force, you know, let's say a year from now, which traditionally has been, I would say, the case. I mean, in a way, when it comes to venture capital. So I'd actually like to get both your opinions on that.
So I think that the attitude of growth at any cost comes when capital is abundant and that's always a sign of kind of the top of a cycle. So it'll come back. I just don't think it'll do it in the next 12 to 24 months. I reckon it'll be like 4 years out. I think the next 12 to 24 months are about solid ideas and sustainable businesses and real value add and solving real world problems. I also think, and you know, this addresses another one of the questions, and that the convergence of impact investing and venture is going to happen more quickly because of what's recently happened. So really there is going to be a focus on healthcare inclusion, access to healthcare, you know, and kind of more thoughtfulness and more alignment with purpose-driven founders. So asset allocators and investors will be held liable to more than just what was the IRR. And I think that will happen faster, and more than the growth at any cost, right? And those two are mutually exclusive. You can't have growth at any cost if you're focused on purpose and purpose driven, and trying to create impact. So far, I'd love to see some business models that prove me wrong.
Okay. Basil, your thoughts on the comeback
Very
of
quick,
growth?
just conscious of time, very quick. I would add two things. I think it's an election year in the US, and believe it or not, that has an impact. A Republican government versus a Democratic government would have different policies on the Federal Reserve and on how money gets deployed in the US economy. And therefore, I guess the short answer is if it goes Republican and stays with Trump, let's say, then you're likely to see money remain very cheap. And there will be a flood of it. If it goes Democrat, I don't know, maybe. It also depends on the House and the Senate. So let's not go into politics, but there's a dimension here of US monetary policy that does impact us in the region and impacts the world, frankly, that we need to keep an eye on. The other thing is money at any cost. Listen, every time there's a bubble, there's a slightly different theme. The last theme was grow at any cost, money is cheap. The only thing the next time it manifests itself, it's not going to be just grow at any cost. It's going to come back to, prove your economics, and then you get more money to expand. Acquisitions, I think, in the next period are going to be very interesting ways to grow, right? Because an acquisition capital will become more available, if you like. So I guess there's other ways to grow quickly, but they might come with acquisition capital, financing, and different methodologies than the unit economics and just throw money at an idea, if you like.
Okay, fantastic. We're almost up with the hour, so I would just like to let the audience know we will be putting a feedback form in the chat. So please do let us know if you'd like to see more about investment. How was this one? Are there any specific topics within venture capital that you would be interested to see? To the panelists, I really appreciate your time and for joining us today. Before we wrap up, I would just like to request both of you, any parting wisdom or advice from investors to existing or aspiring entrepreneurs when it comes to raising capital, just maybe your top 3 tips or advice to the audience before we end the webinar. Noor, you can start.
Sure. So I think that, some things in life never have a good time. It's never a good time to raise money. It's never a good time to start a company. And I think this brings us back to it's not a good time now to do either of the above. And yet it's the best time there is because people are listening. People are looking for innovative solutions. People are looking for visions and for hope. And the capital exists. It's about finding the right capital. So the first piece of advice is align yourself with the right capital. That's long-term. The second piece of advice is if you believe in something, go build it. And the third is look for your clients first before your capital, not first the capital, then the client. So that's those are the 3 pieces of advice from me today.
For me, it's really, really simple. Yes, we live in incredible times, and it will go down in history. And I'm sure we'll read a lot about it in the next few years. But history does repeat itself as well in terms of how people behave during those times and how people act. There's some great books out there, Ben Horowitz, The Hard Thing About Hard Things, read it. That's an interesting one in the context, especially if you think about it in the context that we live in today. And if you're gonna come talk to a VC, get to know us before you talk to us, please. It helps make the conversation a lot smoother, that's all.
Definitely. Very useful pieces of advice and information to the audience. If you would like to, review the webinar, we will be putting it on YouTube and we will put it on our social media channels. So keep following us there. The Small Biz UA webinar series will continue. So just keep checking our socials for the next topic that we will be discussing. To the panelists, absolutely enjoyed our conversation. you know, we covered so many things, and I really appreciate your time for joining us today. And to everyone, you know, stay safe, stay healthy, and see you all next week.